Good morning and welcome to the Pantheon International PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and they can be submitted at any time by the Q&A tab situated in the right corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Charlotte Morris. Good morning.
Good morning and welcome to everyone joining us on the line today. So I've got some slides here. I'll take you through a presentation, a little bit of a recap on what Pantheon International is and how we're approaching the private equity market, but then also covering the results for the year and at the end coming to some questions. So maybe just to kind of get started, level setting a little bit. I'm sure many of you are familiar with what Pantheon International is and why it's attractive, but really what Pantheon International offers is the opportunity to invest in private companies. So get access to a portfolio of private companies managed by the groups that we think are some of the best private equity managers out there. As you think about portfolio construction across an investment portfolio, there's obviously sort of different elements of public investments that are attractive to have. But actually, when you think about diversification, having some exposure to private assets and private companies offers something quite different from what you see in public markets typically. So we think that this is an attractive component to add to a portfolio. In terms of Pantheon International specifically, we are one of the longest and most well-established investment trusts listed on the London Stock Exchange since the late 80s. So we are investing in private companies. About half of what we do is directly into company investments, and that is complemented by some commitments to private equity funds that are typically access constrained, difficult to access, oversubscribed funds that complement those companies that we pick up on the direct investment side. So what we do is offer a well-diversified, balanced portfolio, a sort of one-stop exposure to private equity. And all of that is overseen by an independent board that holds Pantheon as the manager to account and is really there to put shareholders first and be working for your interests. So if you look at Pantheon International's portfolio as it stands at the end of the financial year, which ran to the 31st of May this year, so already coming up to just over 3 months ago. On the left-hand chart here, you can see what I was just talking about. So 54% of the portfolio is directly invested into companies, and that's complemented by the fund investments. Then on the next pie chart here in terms of stage, Pantheon as the manager of this vehicle is sort of a specialist in mid-market investing. So the smaller end of the buyout spectrum, investing in slightly smaller companies, still very well-established businesses, but companies that are nimble, can grow quite rapidly, have lots of flexibility around how they can grow and develop, and then also a lot of flexibility around their exit. So we really like that kind of mid-market, small mid-market buyout and growth end of the market. The third pie chart here gives you a sense of the geographic distribution. So more than half the portfolio is in the US. That's the deepest private equity market globally, but a solid component with a third of the portfolio in Europe, and then the remainder made up of global and Asian investments. And then finally on the last pie chart on the right here, the sector diversification. We are looking for businesses that are exposed to slightly more resilient and defensive sectors. We invest consistently through market cycles. So one of the ways that we try to mitigate the risks and challenges around market cycles is by investing in businesses that have long-term tailwinds behind them, are really sort of riding on secular trends, or are operating in sectors that really are more resilient and don't tend to be impacted by market cycles. And that in our portfolio typically means technology and healthcare. They make up more than half of the portfolio, and within technology that is primarily software businesses where you have recurring revenue streams, sticky customer bases, where you can be offering something that is critical for your customers, actually in the way that they operate their own businesses, and that creates that customer stickiness. Similarly, in healthcare, there are trends there, things like aging demographics, that can underpin the businesses there and make them less related to market cycles. So really what we're offering here is a nicely diversified, balanced portfolio that gives you exposure to global private equity. This past year has been a very busy period, so there are a number of initiatives that we have been working hard on, both in terms of the manager, but also with our board. And on the top left here, we've been really focused on capturing value for shareholders. As I'm sure you are aware, the listed private equity sector has been trading at a discount across the sector, and PIN is no different in that regard. So while there has been a wide discount on the shares, we have been in the market doing share buybacks, which are accretive to shareholders. And during the financial year to the end of May, the company invested £53.5 million into share buybacks, and those, as I say, have been accretive to the NAV per share. Subsequent to the end of the financial year, the board again has prioritised buybacks and allocated a further £30 million, and we've been in the market since the end of May, continuing to buy back shares and capture that value for our shareholders. This isn't something that in the long term really fixes the discount, but while the discount is wide, we have strong conviction in our portfolio, and at those levels of discount, it is a compelling investment opportunity to buy back those shares. We also augmented that with new investment activity that lays the groundwork for growth and investment performance over the coming years, and we'll come back to that in a few slides. We've also done quite a bit of work. You'll have heard our chair speak about his three-step programme that included the big share buyback that we did coming up to 2 years ago now, that £200 million programme, and the ongoing capital allocation policy. And step 3 of that programme, we've done a lot of work on that over the course of this year, in particular thinking about different elements of strategy. So 2 that we've called out here on the top right are refining our approach to active portfolio management and active capital management. So thinking about sources and uses of capital and making sure that we maintain prudent approach to gearing, but also trying to mitigate the challenges of market cycles and smooth out consistent investment throughout. And then in terms of portfolio management, we've been refining our investment strategy and really focusing in on the core of our portfolio, the GPs that we think, the managers in the market that we think are the leading private equity managers, and focusing even more on that group of managers. Then the thing that does really have an impact on the discount is increasing demand. And that has been a core area of focus for us as the manager, and also for the board over the course of this year. And we continue to be really proactive in thinking about how to broaden the reach of Pantheon International, appeal to a wider set of investors. And that has involved work around, market segmentation, partly some work in terms of market education on what private equity is, what it isn't, how it can be an attractive component of a portfolio, but also really sort of getting out into the market and raising the profile of Pantheon International specifically, including things like a refreshed brand that you'll be seeing rolled out over the coming months, and some campaigns on LinkedIn that we've been running, really testing out messaging and ways to access newer shareholders to come into the vehicle. All of that really is with the board's stated aim of putting shareholders first. So, you know, the chair in particular and the board more widely has really engaged with various stakeholders in Pantheon International, trying to understand the views and needs and perspectives of our investors, and really continue to implement strong governance of the company and work with us as a manager team with the aim of narrowing that discount and creating value for shareholders over the medium to long term. If we take a step back and just have a look at how the portfolio has evolved, we've shown this slide before, so many of you may be familiar with this. The portfolio continues to evolve from 10 plus years ago, where it was an exclusively funds portfolio, to now, as I mentioned before, more than half of the portfolio in direct company investments, where we can be really specific about picking our spots and managing the sort of unfunded commitments that come with the fund exposures. And in the middle, what that has also meant is that our portfolio has become more concentrated than it has been historically. So we've sort of almost halved the number of companies that make up the top 80% of NAV. And on the right-hand side, you can see that at the asset level, the companies in the portfolio continue to grow. These stats in terms of revenue and EBITDA growth are showing the last 5 years, the growth that we've seen in our portfolio compared to what has been experienced in the sort of a public market benchmark here using the MSCI World. So all of this really is kind of underpinning what we've articulated in previous years, the deliberate shift towards more direct investment, where you can be very specific, pick those spots, choose those more resilient exposures, and manage the age of the portfolio. And at the moment, the average age of PIN's portfolio is 5.6 years. We've summarised on this slide the overall performance across the year. You can see in the second box at the top here that the NAV per share growth over the year was 1.2%. So actually at the investment level, we saw valuation gains of around 6%, but they were offset by quite strong headwinds in terms of the US dollar that resulted in a 4.8% decrease on NAV per share. When we look at the sort of last 10 years, though, we see quite healthy NAV growth of 12.2%. And what we're hopeful for is, as the private equity market continues to show signs of improving, that we'll start to see the NAV per share performance pick up over the coming years. The share price performance in the year was quite disappointing, with that negative 9.2% movement, in large part because of the discount widening. So at the point where we ended the year in May, we were still seeing some impact from the volatility that had ensued in the market after Liberation Day and the noise surrounding announcements around tariffs. That discount has narrowed from what was sort of in the 40s in May to now come into the low to mid 30s. And when we look at the what's made up that NAV per share movement over the year, as I said, the valuation gains were 6% or so, but offset by that real headwind from FX. Again, after this period end, we've seen that come back with strengthening in the currency that you'll see on a coming slide. And then as we look across the portfolio on the right-hand side here, you can see that venture was a strong performer over the year. That does only make up 5% of the portfolio, and that is by design. We are only in the absolute top tier venture managers, really in the top 5% of managers there. There's a huge diverse dispersion of returns within venture. So we're very specific about only investing in the absolute top tier managers there. And venture can be more volatile because the valuations can happen less frequently, and you can see some real pops that can move the needle quite significantly. But across the other stages, we've seen pretty consistent growth with strong performance across each of the different stages. What's been really interesting when we think about the context for PIN, so the wider private equity market, there have been a couple of years of quite muted activity, particularly on the exit side that generate the distributions when companies are sold from the portfolio. And you can see on the top left chart here that our annual distribution rate, so that's the proceeds that we had coming back from the portfolio during a year relative to the opening NAV. In 23 and 24, those were really at lows of 10 and 8%. And we were really pleased to see that 8% increased by 50% up to a 12% distribution rate for this financial year. And what that comes in conjunction with that distribution rate is what we typically observe within our portfolio is that when a company is sold, the proceeds that we receive are higher than the valuation that the manager will have been holding that company at before they chose to sell the business. And you can see that in the top right-hand chart here, where the businesses that were sold during the year saw a 25% uplift relative to the holding value before they were sold. So consistently, we see that across the portfolio. You can see that going back over the last 10 years here. There is obviously a range there, and it can go up and down, but it is consistently an uplift. So we are hopeful that as we are seeing signs of exit activity recovering in the wider private equity market, with that distribution rate ticking up, that as we continue to see that evolving over time, that we'll see more of that uplift on the valuations coming through, and that will be a boost to the NAV per share performance. Call rate has stayed pretty steady, ticking up a little bit this year. And what's really important is that despite these lower distribution rates in recent years, PIN's portfolio has continued to be cash flow generative, generating £1.5 billion since 2016, so over the last 10-year period or so, and consistently generating net cash inflows each quarter and each month, which we're really pleased to see. Just turning to the balance sheet, the gearing at the end of July, so this is rolling forward from the financial year end, was just under 10%. So that's in line with the guidance that the board has provided previously. And in terms of our coverage of the undrawn commitments, that's very comfortable with 4 times financing cover and an 80% undrawn coverage ratio. So good coverage of the commitments that remain, that we are quite prudent in how we estimate that. So taking a quite cautious view on the level of unfunded, even though some of that is very, very unlikely to be drawn. So I mentioned before sort of the activity that had gone on in the portfolio. And if we look first at the sources of capital, so cash that was coming into the portfolio, I mentioned just now that we saw a 12% distribution rate with almost £300 million of proceeds coming back during the year, that 25% uplift and a 2.3 times cost multiple on the exit realizations during the year. So on the right-hand side, you can see some of the largest exits that we saw. So some quite lumpy exits here, coming from the fact that we have been concentrating the portfolio. So many of these exits that you see on the right-hand side are from single company positions, whether those have been co-investments or manager-led secondaries, high conviction plays where we've selected specific companies to exit. And at the bottom here, you can see that just over the last 3 years, we've consistently generated net cash flow, and the exits that we've seen across the portfolio have come from a variety of different sectors. And on the right-hand side at the bottom, really consistent with what we see historically, 6% or so of the exits came from IPOs and secondary share sales. That isn't typically the biggest source of our exits, which is one of the things that puts us in a stronger position when you go through different market cycles and where the IPO window can be closed. What we did see during the year across the 2 most common sources of exit, so secondary buyouts, that's where a larger private equity buyout manager buys one of our businesses from a mid-market buyout manager, and trade sales, where you're selling that company to a larger company operating in the same sector. Those two typically make up the majority of our sale routes. But during this year, we saw a tick up in the secondary buyouts. So the large and mega sponsors do have a significant amount of dry powder, and their real hunting ground is mid-market companies, private equity-owned businesses, where they have a good sense of the quality of those companies and know, therefore, that the management teams are used to working under private equity ownership. In terms of the uses of capital, so how we deployed the cash that came back from the portfolio, we had almost a 50-50 split between investing capital into share buybacks that I mentioned at the outset and new investments where we deployed cash into them rather than just commitments. You can see the evolution of the buybacks over the course of the year. In the Q4 in particular, the discount went out quite wide, as I said, off the back of the volatility after the Liberation Day announcements. And the board took the opportunity to really lean in and invest quite a lot of capital into buybacks during that period. In terms of the new commitments, as I said, this is really important for laying the groundwork, the engine for NAV growth over the coming years. We invested across a variety of different stages and consistent with our geographic splits. And at the bottom here, you can see primary fund commitments that we made with some of the top private equity managers that we support, and co-investments and manager-led secondaries where we were investing in specific companies, really sort of leaning into some of the themes that I talked about in terms of healthcare and technology businesses. When we look at the top 25 companies in the portfolio, I just pick out, as I think about the exit activity picking up, we've had a number of companies within the portfolio where we hear from the managers that they are on the exit ramp and they're actively in processes. But what I can talk about on this slide in particular is there are a number of companies here that have announced publicly, or it's been in the press, that they are in exit processes, in particular around IPOs. So Visma has been in the headlines about a potential London Stock Exchange IPO. Similarly, Frenary has been in the financial press around an exit transaction. Wiz announced an exit sale to Google earlier this year, and we're just waiting for the completion of that. That should come over the coming months. SailPoint IPO this year. Kilcoy Global Foods, number 22 there, also filed for IPO. So the things that we know about in the public domain give you some indication that the exit activity is tangibly starting to pick up across private equity. And then just to turn to governance and the board, as you may have read in our annual report that was published at the end of July, there are some changes coming to the board composition. Most notably, in terms of our chair, John Singer will be subject to reappointment at the AGM. It will be continuing through until the end of this year. And Tony Morgan, who joined the board in January, will be taking over as chair from the beginning of next year. There are a couple of other new board members that joined in January. So at the bottom of the faces there, Tim Farrismond and Canada Morley joined in January. They both, alongside Tony, have significant private equity experience, so they're very knowledgeable additions to the board. And as announced in the annual report, John Burgess will also be retiring at the AGM next month. So then finally, just to kind of roll forward the performance through to July, you can see here that at July, the NAV per share is up 2.8%, and part of that is coming from valuation gains. But as I mentioned earlier, the FX impact has reversed and is now a tailwind for the NAV per share with the 2% contribution over those couple of months so far. So then finally, just to end here, over the long term, and that's sort of what we look to with a private equity portfolio, we have generated strong performance, outperformance relative to public markets. And as I say, are offering here really this nicely diversified, actively managed portfolio, giving broad exposure to private equity. And with that, maybe let's get into some of the questions.
Perfect. Well, Charlotte, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions, and you can do so just by using the Q&A tab that's situated in the top right corner of your screen. We have received a number of questions, both pre-submitted and throughout today's live presentation. I'll start the Q&A session off with the first one here, which reads as follows. Could you explain the relative attractiveness of the small market compared to the large market, and why are returns often stronger on average in the smaller market?
So I touched a little bit on this during the presentation. There are a few sort of structural things about smaller companies that make that part of the market attractive for us. First of all, there is a huge opportunity set, thousands of smaller companies that can be targets for private equity ownership. And particularly what we like is where our managers are buying founder-led businesses, buying from families where they are the first institutional capital coming in. And what that means in practice is that there's often quite low-hanging fruit, opportunities to help professionalize a business, sort of transform it into an organization that can grow more sustainably and make it an attractive target for those larger private equity sponsors and larger trade buyers. So there's a real opportunity with smaller companies that are becoming private equity owned for the first time. And as I touched on before, there are lots of different ways to grow small companies. You can imagine that it's much easier to grow double the growth of a company that is maybe £50 million of earnings or profit than it would be to double something that is £1 billion of earnings. So you can be much more nimble at that smaller end. And then there's a lot more flexibility around the exit routes. The last thing actually I'd say that also kind of speaks to returns is you can come into smaller companies typically with quite attractive entry pricing. So we don't have it in this presentation, but if viewers go onto our website and look at the kind of monthly investor presentations on there, you can see at the back there's some statistics around market data, and what you see is that the multiples that larger transactions complete at are higher than what you see in the mid-market. And obviously they are smaller, less sophisticated businesses often, but that provides an opportunity to get that multiple arbitrage if you scale a business or improve it such that someone's willing to pay up for it at exit. And the last thing I'd say is that typically they have lower levels of debt, and just in the way that Pantheon approaches the market, and that's also inherent in PIN's portfolio, we prefer debt to be used less aggressively. We're just a bit more cautious about the use of debt, and so that aligns quite nicely with the smaller end.
That's great. Thank you very much for that. I've got another question here. What do you think about the relative attractiveness of the US, Europe, and Asia for returns going forwards? And are you reallocating at all?
That's a great question, and one that actually in individual meetings with shareholders we've heard, particularly in recent months. And I think it's a topic that is sort of more widely in just financial circles, something that is on people's minds, particularly off the back of the volatility and the concern about the macro outlook for the US after these tariff changes have come about. I think I mentioned this before, private equity is a long-term asset class, and we think about asset allocation and portfolio construction in a long-term way. And we don't try and react to shorter term changes in the market landscape. And whilst there are some investors that are saying that they are, de-emphasizing the US instead of emphasizing other regions, we haven't taken a sort of big picture stance like that. But what I would say, Joe, just in terms of the deal flow that we see, obviously I sort of specialize on the secondary side. I see a lot of the manager-led secondaries coming through, but it equally applies to co-investments. We have seen some really attractive opportunity within Europe. I think it is more fragmented and it is a more challenging market to navigate, and you need local partners, you need to be on the ground. The managers that we work with are often country or regional experts, well networked in their target markets, and that's really important. So we've found through our managers that they've been able to uncover quite attractive opportunity within Europe. But in the longer term, we haven't made any changes to our geographical tilts for the moment.
That's great. Thank you very much. How do you engage regarding the environmental sustainability of your investments?
So sustainability is something that goes through our investment process, right from deal screening and diligence all the way through to portfolio monitoring and how we kind of engage with our managers on an ongoing basis. One of the elements within our diligence approach that is consistent, whether it is fund selection and choosing a manager or asset selection on one of the direct investments, is that we complete sustainability scorecards that are slightly different for those two different types of transaction, whether it's asset-based or manager-based. And on the manager side of that, we are in the scorecards where we're rating them on their approach to sustainability. We are engaging with them in terms of environmental elements, particularly on climate and biodiversity. So within those scorecards, there are questions that we're asking and then ranking how we see them in terms of, a score effectively of their maturity or progression towards really incorporating and prioritizing climate and biodiversity in particular. We rate about 230 managers at the moment on how we see their credentials there. And then that forms the basis for our engagement going forward. So that is, first of all, when we go back to them to give them the results of the scorecard and compare them to others in the market and give them guidance on whether they are really leading the market and pioneering or whether actually they're quite far behind and that we have expectations of them to significantly improve. It can impact whether we will support a manager going forward. And then it's through those one-to-one interactions on an ongoing basis that we continue to come back to sustainability as part of the ongoing monitoring process. We also have a third-party piece of software that we use to identify sort of issues and incidents that have happened with portfolio companies that we also use as a tool to come back to managers and engage around specific issues, company-related issues.
That's great. Understood. Thank you, Charlotte. We have had quite a few questions on the discount on shares, so perhaps maybe I'll just group them together. Why do you think it persists, and what else can be done to close it?
I mean, that is priority number one for us, is really working on the discount. There are different things that have affected it and kind of made it so persistent. The biggest one really is a few years ago, the kind of disconnect between public market valuations and private valuations. I think there still is some skepticism in the market about private valuations, and it's difficult to dispel that, especially while exit activity has been quite muted, because whilst we feel comfortable about the valuations and confident about the way that our managers approach valuations, in part endorsed by that uplift that I mentioned when companies are actually sold, that if anything, the valuations are conservative relative to the final exit values that they get. That continues to be something that is challenging because private equity is quite opaque, and that lack of transparency, I think, is challenging for a kind of public market wrapper. And that, on that front, we continue to engage with educational initiatives, sort of webinars, speaking at conferences, and also for our own portfolio, trying to increase the transparency around what's in the portfolio, what's doing well, what's not, and how to think about the composition of the portfolio. So that's one big thing. And I touched on it, in that context, that I think the wider private equity market has been more challenging in recent years. And I think we need to see a recovery in exit activity and get back to a more normalized environment that also should help narrow the discount. But fundamentally, it's about increasing demand. And there have been, blockers there, like the issues around cost disclosure. And I think there is some progress happening on that front. We're hopeful that the FCA will come out with some appropriate guidance later this year, or maybe even into next year. But really, it is about putting private equity on the radar of a wider universe of investors, increasing demand from investors that maybe haven't thought about investing in private equity before, in particular sort of individuals, but also in terms of institutional investors across the spectrum. It's that demand piece that also needs to play a part in narrowing the discount.
That's great. Thank you very much. Another question here. There's a lot of information on private equity having a difficult time exiting and returns coming down. What is your outlook compared to this reported reality?
Yeah, I think different people have different views on this. And certainly there are, other private equity groups that have been quite bullish about there being almost a sort of bounce back from the muted activity that we've had. I personally think that this is a kind of multi-year transition, that we will see a kind of recovery over time in the broader kind of private equity market. I do think that there is a shift happening, and what you see when you look at fundraising statistics, for example, and this feeds through into what you see in listed private equity. The landscape for managers raising capital is shifting, and the 10-year run up to 2021 was a really benign period with very cheap debt and the ability for pretty much anybody to generate good returns. And that has changed dramatically. And I think that is altering the landscape going forward. So I feel quite confident, and we did a lot of work on this actually with the board and internally at Pantheon on the outlook for private equity. Like, is the golden age over? Are we kind of going through a period where it won't be able to generate the returns that it has done historically? I think what is changing is that the people that are generating those returns is evolving, and not everybody that was able to generate good returns in the past will be around and able to do so going forward. And I think the landscape of top managers is really important to focus on, because when we do our diligence on primary fund selection and the managers that then feed into the co-investment deal flow that we see, the manager-led secondary deal flow that we see, we scrutinize how have they generated their returns in the past, and really get down to the level of, has it been from quite aggressive use of debt and a bit more sort of financial engineering, because that did very well in that period up to 2021. I don't think it's going to do as well going forward from here. Similarly, someone that has ridden the market and done well in terms of multiple expansion just because a sector has sort of evolved over time, that's something that we are much more skeptical about, and where we want to focus our investment and support is with the managers that have genuinely transformed their businesses, and where their returns have been primarily from operating company performance, growing top line, helping them grow market share, maybe doing a sort of consolidation play, but genuinely growing the company and increasing its performance rather than some of the sort of bits around the edge. So when it comes to the outlook from here, I think that private equity overall will be able to continue to generate strong returns and outperform public markets. But I think the groups that are doing that and the composition of the manager landscape will change. And you'll see some of those groups that weren't really that differentiated struggling to raise capital and maybe even falling away, and really the kind of capital being concentrated in the groups that genuinely can perform in the way that they have done historically. Sorry, that was quite a long-winded answer. I hope that answered the viewer's question.
Thank you very much, Charlotte. We have had another question here. Geographical distribution shows Europe. If you could just give a bit more colour on what proportion the UK is, that'd be great.
Yeah, the UK is only around 7 or 8% of the European exposure. So within Europe, the UK is arguably the most, the deepest of the private equity universes. There is a really strong manager set in the UK. So I think relative to the rest of Europe, it probably punches above its weight in terms of contribution to the number of deals and number of managers, the performance. But it is still a component of Europe. So it's we keep it sort of at that 7-8% type zone.
Perfect. Thanks for that. Another question here. Do you hedge the currency at all?
That is a very topical question, and we don't. It is one of the things that is under review with the board as part of the Step 3 strategy review that we've been doing. Over the long term, the currency movement sort of balance out over time, but I think we've seen probably a bit more currency volatility recently, and so we're revisiting whether we should bring into play a bit more hedging. There is an element of a natural hedge on a portion of the portfolio because the private placement notes, excuse me, the private placement notes that we put in place about 18 months ago now are dollar denominated, and so that is a natural hedge for a portion of the dollar-based portfolio. But no, not at the moment.
Thank you very much. Turning to the next question, how many shares do managers and staff own?
So on this page here, I skipped over it, but on the left-hand side at the bottom there, you can see where it says strong alignment of interests. What we disclose here is what the partners of Pantheon own, and for various sort of regulatory reasons, it is UK partners. So 1.6 million of shares. That's based in July. That's what was disclosed in the annual report. Beyond that, though, the company is actually held quite widely across the employee base, and it is something that a significant number of our staff own, either directly but also through their pensions. They're able to select it in the pension that we offer at Pantheon, and a significant number hold it through that as well.
That's great, Charlotte. Perhaps one final question. Could you give some recent examples of new investments, single companies or primary funds?
Yeah, so let's come back to this page. On the far right-hand side, just to pick out a company here, at the bottom left, you've got IPD, and this is a dental components business in Europe. And what they are producing is what are called sort of abutments and other kind of components for dental work. And an abutment, for example, is a a piece that you sort of drill into your jaw that you can attach a crown to. So if you think about, again, kind of aging demographics, and actually just a sort of rising focus and interest in dental care, they are both sort of secular trends that support this company. So they're offering these components to all different dental networks. And what happens actually in practice is that dentists tend to use a particular type of component, and that's what they get used to using, and they use it consistently. So it has that kind of stickiness amongst the dentists and dental surgeons universe, and it's providing a component where the long-term growth is has that tailwind from aging demographics, people seeking to do more dental work than they have done historically. And then to pick out a primary here on the left-hand side, we committed to IK. So they are a European small and mid-market buyout manager. We have supported them for many years. They have really consistent returns over time. They invest primarily in, they started actually as a Nordics manager, and they invest primarily in the Nordics, German-speaking Europe, France, and Benelux. And we support them through primary fund commitments. We also have done a number of co-investments alongside them. We did a manager-led secondary last year. They are really their MO typically is more buy and build strategies, so consolidating a particular market thesis. So one example of that, which was the theme around the manager-led secondary, was the specialist insurance broker landscape in the Netherlands, where it's a very fragmented market, and they have executed on a buy and build thesis there. So bought a platform business and have really professionalized the approach to buying and integrating add-on businesses, and really turn that into a kind of add-on engine. And there's a huge pipeline there of opportunity that they can consolidate. So that's really their typical kind of thesis. And sometimes the other thesis that's really common to them is building up a sort of country leader in a particular sector and helping them to expand from one country into other countries where they have a specialism and a network where they can support that company to expand and become more of a European player. And that positions their assets really well to sell up to the pan-European large sponsors that really love the type of company that has that sort of profile.
That's great. Well, Charlotte, thank you very much for answering those questions from investors. Of course, the company can review all the questions submitted today, and we will publish the responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, it's particularly important to the company. Charlotte, could I just ask you for a few closing comments?
Yeah, so I hit on a lot of the things that we think are really attractive about Pantheon International, and really this is a way of getting your exposure to private equity with a portfolio that is managed for you, that has that oversight from the board. And there's a lot going on in private equity right now, but I think there's also a lot to be optimistic about. I think we're at a point where we're coming out of what's been a challenging few years, and there's some really interesting developments going on, and that periods of volatility like this create interesting opportunity too. So we're really excited about the growth in the years to come in private equity more widely, but also particularly within PIN. And I hope that you'll invest with us if you aren't already, and come along on that journey with us. Thanks for joining today.
Charlotte, thank you very much for updating investors today. Could I please ask investors not to close this session, as you now be automatically redirected to provide your feedback in order the management team can better understand your views and expectations. On behalf of the management team of Pantheon International PLC, we'd like to thank you for attending today's presentation, and good morning to you all.